bright lights.
Thank you all. Our next panel is on insurance. We're very fortunate to have three global experts on the subject. First of all, Jay Ralph, the chairman of the Asset Management Committee at Allianz and also a member of the board. Second, we have Cynthia McHale, who is the director of the insurance program at Ceres. And on my far left, we have Philippe Derieux, and he is the deputy CEO of AXA Global Property and Casualty. Jay, maybe if I can start with you. Allianz has recently taken the initiative in putting $2.5 billion into renewables. But it has been overwhelmingly in Europe. Now, we've been hearing today from other speakers of the need for investment in renewables in developing countries, in China, in other parts of the world. Why is all of your, or practically all of your investment so far in renewables here in Europe? Is it currency risk? Is it political risk? What is producing that concentration in Europe?
Right. It starts that we're a liability-driven investor, and the bulk of the Allianz balance sheet sits in Europe, and therefore we're looking at Euro assets, and in fact, long-life Euro assets. And in that sense, infrastructure and renewables fit extremely well in that portfolio. Also, we saw great opportunities there. Now, as some of those opportunities are now going to other areas, we in fact will diversify our portfolios. We've looked at things in Asia. We've looked at opportunities in the United States as well. And I think we will go there because we have portfolios in those markets as well. But a lot of it has been driven in the concentration of our portfolios within Europe.
That makes sense. Cynthia, I know you've been concerned about the silence of the American insurance industry on issues of climate change. And it's conspicuous we have ended up with top executives from two European insurers here today. What to you explains the silence of the American insurance industry on the question of climate change and climate risk?
Sure, thank you. Well, I ask that question myself often when I speak with US insurance executives to understand that. And I will say I'm a former reinsurance underwriter, so I think about risk and I think about opportunity, and to me, climate change very much encompasses both of those. So it's been a puzzle to me why the US insurance industry is very reticent, even today still, to use the phrase climate change. They'll speak about extreme weather. The reasons that I'm told is threefold. First, we have a very tough political climate in the US, still remaining today, which makes insurance companies hesitant to, as they see it, jump into that political battle. Secondly, they tell me that they are concerned about climate litigation. Again, the United States is a very litigious environment, and the insurance companies, at least the property casualty, or called non-life, also write a lot of liability contracts, and they also insure fossil fuel intensive businesses and industries. So they're concerned that they may be exposing their clients as well as themselves to potential litigation and legal defense costs, which sometimes are even greater than the actual damage awards. So those are the two very big factors: the legal environment, the litigious nature of the business community in the United States, and also, frankly, up until more recently, the social environment. Although I think that's changing. It does seem now, based on the latest polls, that most US citizens are very concerned about climate risks. So that's my best take on the state of play and why the industry remains reticent to use that phrase.
Okay, well, thank you. Philippe, maybe on the property and casualty side, we can talk a little bit about the risk of, whether we call it extreme weather or superstorms. We've had a couple of very powerful cyclonic storms in the past 2 years that have done, one did extraordinary damage and the other one perhaps could have. Typhoon Haiyan, I was one of the first reporters into Tacloban in the Philippines after that came through. The damage was incredible. The saddest part, of course, was the loss of life. Bodies lining the roads everywhere, 8,000 dead and missing. But what was also a lasting blow to the city, although not as important as that, was the damage to the housing. Out of 57,000 buildings, the municipal electricity cooperative told me later, 6,000 of the 57,000 buildings in the city disappeared entirely as a result of storm surge and waves. Another 50,000 were so damaged that they could not readily have electricity restored. Under 1,000 were survived to an extent that you could plug them into the grid afterwards. Now that was a storm so powerful that it went far off the 1 through 5 scale, in fact, of categories of severity of hurricanes. If they went up that high, it would be borderline 7 and 8. So it dwarfed anything in our normal understanding. If something like that were to hit the United States, Mexico, Hurricane Patricia also reached the same wind speed exactly, actually, although fortunately it went ashore in a swamp. What would happen? And is that an increasing risk for property and casualty insurers?
Well, the first point is that we have at this stage, to what we call fix the basics, which means that we've got to review all the modelings about cats. Get at the same time more accurate figures, fortunately through the big data. Fortunately, we have many more data than ever. Secondly, have accurate figures and more, I would say, granular figures about each piece of, if you take a city, each piece of a street, and not just a global view. And also, of course, try to anticipate what could happen, which is not at all easy, but you have mentioned a certain number of storms. We are seeing, this evolution everywhere in the world, that's the first point, with the big storms or big events, but also average size event or small event, but extremely severe for local population, be it in just one city, but destroying a lot. So first, fix the basic, have a much better risk assessment of what happened exactly, or what has happened, and try to then react. So the reaction is, fourfold. The first one is risk awareness. For example, we have recently worked with the French state on the Paris region to create much more risk awareness for SMEs in the Paris region, because they are not always aware that they could be hurt if there is a significant flood of the River Seine. The second part is linked to prevention or mitigation. If you take, you took an example of Mexico, where, fortunately, Patricia went on the territory where there was almost nothing, fortunately. The previous one, Odile, did hurt very much the Baja California, so the low part of California, and it was very detrimental and cost a lot. When, fortunately or unfortunately, hotels are not just located in the center of Mexico, but close to the beach. And so the reaction we have post-event is to help then those people to react and prevent the next one, or to mitigate their risk very much to the next one. If you have a nice open window in front of the sea, that's wonderful for the tourist. That's not wonderful once the wind has broken the window. So, okay, create defense, what we call create defense, new defense, or new ways to mitigate the risk. And then, after that, protect. Protect means that, okay, we will pay a certain amount of money if ever you are hurt. But that's the last part of a journey. And that's the way we react at this stage. For each ever, any customer we have, we need to assess its own risk and tell the customer, well, this is where you are, what you are, how you are at risk. And then you could first help yourself by doing that. And then we will help you by insuring you. And it may happen for individuals, it may happen for enterprises, and we are now working also with companies which are not from our industry, like water suppliers, people like that, to bring a bundle offers to cities.
Okay, thank you. Well, maybe if I might follow up then, there's also an investment angle to these kinds of storms. In the case of Tacloban, for example, after about 10 days, they finally managed to get some stability to the city. They controlled the looting gangs and got sort of gunfire in control, dug some mass graves and so forth. And I went across the island to the geothermal plant. Now, this was one of the ironies of Typhoon Haiyan. Here it was a storm that many have linked to the increasing severity of storms, and yet it had destroyed the world's second largest geothermal project, which just happened to be on that island right there in the Philippines. The geothermal plant's owners had not been prepared for a storm of that magnitude in terms of their insurance, and they struggled to rebuild it. This was 600 megawatts of geothermal, so it was a real blow to the Philippines to have that destroyed. But that's not the only case where we've seen that renewable energy projects have not been adequately insured. And I think of, for example, typhoon damage to wind farms. I think of, for example, in a separate category, that some solar panels have not maintained their efficiency of converting sunlight into electricity as long as people thought. Are you finding that renewable energy carries maybe a higher risk, or that the projects may be underinsured, and that as a result you need to build that into your investment models to ensure an adequate rate of return?
Yeah, at Allianz, the projects that we're doing in renewables, trust me, they aren't underinsured, because we're an insurance company as well. But I think your point is exactly right, which is investors need to really understand that there are engineering risks, that there are insurance risks, and there are financial risks associated with these projects. And so it was almost a decade ago that we set up an entity called Allianz Climate Solutions, which was meant to try to understand how one can evaluate these risks and therefore invest more confidently in the renewable segment. And I think it ties for us very closely with our insurance business, and even more specifically, the engineering piece of that, where we understand the wind turbines, what the characteristics of them, how they're likely to perform, not just in the first year, but also down the road, as well as solar as well. And so the technology, the finances, and then obviously the insurance are risks that an investor bears, and one has to really understand these to be able to get into this segment.
That makes sense.
Great.
Cynthia, Allianz and AXA are two of the leaders in the insurance industry in terms of investing in renewables. But do you think they are going far enough? And is the sector going far enough in terms of its allocation between renewables and maybe traditional fossil fuels of the sort that we just had a question based on Al Gore's point about stranded assets? Are they doing enough?
Great, thank you for asking that question. And yes, I mean, the short answer is that we do see some leading insurers, such as the two we have here, Allianz and AXA, making very public commitments to increasing their investments in renewables. And that's very significant. We're seeing that with other institutional investors. I know according to Bloomberg New Energy Finance, in 2014, there were approximately $360 billion in new commitments to clean energy, and that's a 17% increase over the prior year. So yes, this is happening. I think the longer question here, though, is whether still it's happening fast enough and at the scale we need to transition and meet the challenge of global warming. And that's where the insurance industry really does, like many other institutional investors, but particularly the insurance industry, need to play a much bigger role. We know the industry globally has around 25 trillion in assets under management. In the US, that's around 7 or 8 trillion. We know also that of those amounts, only about less than 1% is invested in clean and renewable energy, and yet the sector continues to have many, many hundreds of billions of dollars invested in oil, gas, coal, and fossil fuel intensive utilities. That's a risk for insurers as investors. It also keeps them from participating and making us able to achieve what we often refer to as the clean trillion. So that figure I mentioned, that Bloomberg New Energy Finance figure of $350 billion in 2014, that in fact needs to increase by 3- or 4-fold up to and over $1 trillion each year to hit the target of 2 degrees Celsius limit for global warming. So there's a huge potential here for the industry to step it up. What we need coming out of Paris and COP21 is a very clear, ambitious, strong commitment to a trajectory which puts us on a path to limiting global warming, that sends a signal to the insurance industry as major investors that that's where they need to start transitioning their portfolios.
Thank you. Coming back again, Philippe, on questions of extreme risk from climate change. I think a lot of people think of the risk as particularly wind damage, but there's also water damage, and it's the frequency of events. I think of just a few days ago, 5 feet of rain in Madras, now known as Chennai, in southern India. So how much are you concerned particularly by the accumulation of these events? We also, for example, saw extraordinary weather and tornadoes concentrated in Brazil. Again, things that don't quite maybe reach the international consciousness, but are accumulating at a level that really maybe starts to affect the premiums and maybe also the financial results of insurers.
Yeah, before just answering your question, maybe with the climate change, we are seeing something which is changing in the insurance world. Normally, the assets are backing the liability. Now the liability is backing the assets because the liability helps us to assess exactly what is the exposure on climate for the asset investment, and that's what we do. So that's a change. Now, answering your question is, well, there are a lot of local events which are not maybe seen in the press because that's very local but extremely severe. We speak always about large storms because that's very, I mean, you see it, that's very important, and everybody is frightened by that. Everybody here in this room knows that there are also a lot of floods, heavy rain. What happens with the climate change is that it's maybe not also always huge events, huge storms, but much more rainy weather. And when you had just a storm which just end within 2 hours, that's not an issue. If it is 2 days heavy rain, what happened in the south of France recently, well, that's a major flood. And it happens in every country, or many countries, be it in Europe, be it in the US or Latin America. Asia is very much concerned because the cities are so close to the sea level that they are flooded very often. I mean, I was in Jakarta last week to bring to my entity a new flood model for them that's extremely dangerous for them. That's the same for Bangkok, that's the same for many other cities. So there's a higher frequency of not high size events, but very painful for the local population and with a significant destruction rate, as we say. So that's the trend, and we've got to be close to to understand that that's not only the big events, but also a lot of severe small events which are coming with a higher frequency, be it hailstorm, for example, or heavy rain, and things like that, which comes and really are disruptive for the economy, and specifically for the local economy and all the maybe not the big enterprises which have some ways to avoid that, but all the economy for SMEs and the population.
Thank you, and by the way, we have time. I'm going to ask one more question of Jay here, and then I'm going to put it open to the audience. If you have questions you want to send in writing, it's q@nytimes.com.
Keith, can I just make one
follow-up.
comment there? One situation we see in the U.S., which is where I focus a lot, is that the premiums still today that insurance companies are charging aren't reflecting the increased risk that climate change has introduced. So whether that's flooding or a surge from storms. And this is one of the concerns we have because we don't have a clear market signal going out to business owners or individuals or homeowners or any exposure around the changes and the increasing risks that they're facing. And I think a lot of that has to do with the reality, in addition to the fact that it's a very competitive, what they call a soft insurance market right now. But the industry's approach to pricing has always been to look in the rearview mirror and to use that data to develop their pricing. But in a time of climate change where everything is changing, looking in the rearview mirror doesn't really tell you accurately what the risk landscape is today and what it will be going forward. So then we have these big events and the industry reacts by limiting coverage or quickly raising rates, or even some insurers will withdraw from a market. So it creates a destabilizing insurance capacity when the industry is not looking at changes in risks and pricing accordingly.
For those who don't follow the insurance industry, it's a rare day when critics or skeptics on some parts of the insurance industry say that premiums are not high enough. So it's a sign of concern that people are saying premiums are not high enough and they're not part of the insurance industry. Let me throw in one more question for you, though, Jay, and it relates a little bit to this. On the investment side, are you seeing any concern from the regulators as to how you allocate your resources and whether you are exposed to the stranded assets, whether you need to be balancing between fossil fuels and renewables, whether you need to be balancing perhaps in your country portfolios between fossil fuel export-dependent countries like Russia, and not as though you put a lot there, but versus countries that maybe export other materials. How much, if any, regulatory attention are you seeing on this? And as the regulators start getting interested, how are you trying to shape whatever metrics they may use to measure this?
Well, clearly, regulators have had an active dialogue with financial institutions, but we haven't seen a lot of regulation coming into the ESG area yet. However, what I'd tell you is that really one of the drives for our announcement to say that we wanted to exit coal-intensive businesses was driven by a group investment committee meeting we had, and when we looked at an investment, we saw that in the time horizons that we were looking at to back some of our life portfolios, which could be 30-year life plus assets, that we felt that there was a serious risk around seeing stranded assets. And I think increasingly, as there is a question then on the viability of investments in your portfolio, no doubt regulators will also react. But I would say it was really driven more from the business side than the regulatory side.
Okay, thank you. Why don't I ask for a question now, first of all, for those who've written to q@nytimes.com, and then for those of you here, if you have a question, I'll ask you to raise your hands next. But let's get a question first from those written in.
This is not my question, I'm reading it out.
Yes, exactly.
My premiums are skyrocketing. So the question is, do insurers really have an actuarial handle on climate-related risks? Or is something going out in determining, is something else happening in determining the pricing in insurance? So it's really a question about, do you have a handle on the actuarial risks involved?
Maybe Philippe, since property and casualty.
Yes, of course, we are extremely and very much involved on an actuarial standpoint. And but when we speak about price increase, that's one component of the equation, not the only one. Because speaking about price, say, well, I mean, okay, guys, your risk is increasing, I increase the price, is a very simple answer. The answer is more complex than that. So first, try to mitigate your own risk. Try to reduce your risk, and then we will help to do that, and then we will see how we can price it adequately. But actuarial development on pricing on a climate, huge, huge. A lot of efforts are made on this to this respect, either to model the risk itself, that's mean what we call the module hazard, that mean the storms or the floods themselves, and then also then you have, of course, the exposure itself of the people. And so we spend more and more time, money, and teams on that, much more than in the past. And once again, thanks to the open source, the open data, it has changed totally, and that's a total revolution compared to the past. But takes time. Takes time to really cover the whole world for all type of perils, of course. But it's a journey we have started, clearly.
Hurricane Sandy has certainly caused a reassessment, I guess, in New York City. With that, why don't I see if we have some hands in the audience here.
I have another question too. This one
You have another one? Let's take another one
Yep.
then first from the
this one comes from Miranda Johnson of The Economist magazine. And she's wondering, what lessons can the insurance industry learn from El Nino climatic events, especially given we know roughly what impacts are likely to happen where, that they can apply to addressing the impacts of climate change? So what lessons can be learned from El Nino climatic events? And she assumes that we know roughly what impacts are likely to happen where, that can be applied to addressing the impacts of climate change.
Jay, I'll give you a
Yeah,
chance here too.
maybe I would just comment. I think natural catastrophe forecasting in the last 20 years, and I started in the reinsurance business, has evolved phenomenally. So the understanding of earthquakes, the understanding of windstorms have had a significant effect. And in fact, El Nino is one of the drivers to understand whether one thinks the upcoming hurricane season will be more adverse or less adverse. So clearly our knowledge of climates and our understanding of climate change educates our ability to help to manage risk and obviously to price risk.
Just add to that too. So we do talk a lot with the catastrophe modelers, the leading ones in the US. So that would be AIR worldwide, or excuse me, RMS or EquiCat. And we know that those leading modelers are working very hard to try to understand climate change and its impacts, and using that data to inform insurance companies. There are a number of challenges, though, that are explained to us. One, the industry doesn't insure against climate change, they insure against specific perils. And some of the perils associated with climate change aren't that well understood yet. So the science continues to advance, but we don't know for sure, whether tornadoes in the Midwest will increase or decrease related to climate change. Those cause some of the most significant damages. So there's just knowledge yet to be gained. I think also for the insurance industry, when they underwrite, they're underwriting a particular building or a particular property. So that climate data or peril data has to be really, really granular. So again, getting it down to that level, sea level rise is another example where you need to understand a lot of facts about that piece of the coastline to know whether and how the risk, let's say from storm surge, has increased and to what degree. So again, the changes in our climate do introduce a lot of challenges for property and casualty as well as life, but we'll leave that aside for now in terms of their underwriting and pricing.
Thank you all very much. We actually are out of time now, but we appreciate all three of you are spending the time to talk to us about insurance and climate change. Thank you very much.
Thank you.